Start, sir.
Okay. So very good afternoon to you, all of you students. And today in the management accounting, we are going to do capital budgeting. Now the word capital refers to the total investment of a company or firm in money, tangible and intangible assets. Whereas budgeting as defined by Roland and William, it may be said to be the art of building budgets. So budgets are a blueprint of a plan and action expressed in quantities and manners. Now, the examples of capital expenditures are number one, purchase of fixed assets, such as land and building, plant and machinery, goodwill, etc. The expenditure relating to addition, expansion, improvement, and alteration to the fixed assets. Then the replacement of fixed assets, then research and development project, etc. These are the capital expenditures. Now, according to the definition of Charles T. Horngin, capital budgeting is a long-term planning for making and financing proposed capital outlays. And according to the definition of G.C. Philippatus, capital budgeting is concerned with the allocation of the firm's source of financial resources among the available opportunities. The consideration of investment opportunities involves the comparison of the expected future streams of earnings from a project with the immediate and subsequent streams of earning from a project with the immediate and subsequent streams of expenditures. Now, according to the definition of Richard and Green law, capital budgeting is acquiring inputs with long-term return. Now, again, there is a definition, according to the definition of Lyrich, capital budgeting consists in planning development of available capital for the purpose of maximizing the long-term profitability of the concern. Now, there are certain obvious need and importance of capital budgeting. Firstly, huge investments. Capital budgeting requires huge investment of funds, but the available funds are limited. Therefore, the firm, before investing projects, plan and control its capital expenditure. Then, second item is long term. Capital expenditure is long term in nature or permanent in nature. Therefore, financial risks involved in the investment decision are more. If the higher risks are involved, it needs careful planning of capital budgeting. The third one is irreversible. Irreversible means once you take a decision, so the capital budgeting, that is employment of capital, is concerned in long-term projects, then you are not in a position to revert back. So irreversible means the capital investment decisions are irreversible, are not changed back. Once the decision is taken for purchasing a permanent asset, it is very difficult to dispose of those assets without involving huge losses. And that's why it is called irreversible. Point number 4, long-term effect. Capital budgeting not only reduces the cost, but also increases the revenue in long term and will bring significant changes in the profit of the company by avoiding over or more investment or under investment. So both over and under investments are not required. Over investment leads to be unable to utilize assets or over utilization of fixed assets. Therefore, before making the investment, it is required careful planning and analysis of the project thoroughly. Now, we are directly coming to the methods of capital budgeting of evaluation. Now, whether capital is to be invested in capital assets or not, and if it is invested, then in which asset the investment should be done, and how to select a project, that is called, and this is done through different methods of evaluation, and that is called methods of capital budgeting of evaluation. By matching the available resources and projects, it can be invested. The funds available are always living funds. There are many considerations taken for the investment decision process, such as environment and economic conditions. Now, bearing these environment and economic conditions, the methods of evaluations of capital budgeting of project can be classified under two broad headings. One is called traditional methods or non-discount methods. And under these, we are having payback period method, post-payback period method, and accounting rate of return. And so far, modern methods are concerned, these are called discount methods. Under these, we are having number 1, net present value method. In short, it is called NPV. Then internal rate of return, that is, in short, it is called IRR. And the third one is called profitability index method. Okay, so we are going to have both traditional methods and non-traditional, that is modern methods. That is, traditional methods ignores the time value of money, but modern method takes into consideration the time value of money. And it is seen from the chart that traditional method and modern methods, and we are going to discuss one by one the various methods under traditional as well as modern methods. Now, when we start with payback method or payback period, now as the name suggests, payback period is the time required to cover the initial investment in a project. So when you have actually invested certain amount of money in the form of capital investment, then payback denotes or payback period denotes the period in which you are in a position to recover the initial investment in a project. It is one of the non-discounted cash flow methods of capital budgeting. And accordingly, payback period is equal to initial investment divided by annual cash inflows. Now, merits of payback method is it is easy to calculate and simple to understand. Payback period method provides further improvement over the accounting rate of return. Payback method reduces the possibility of loss on account of obsolescence. Okay, now what is the accept or reject criteria? So far, the payback period is concerned, for which we may say if the actual payback period is less than the predetermined payback period, the project would be accepted. If not, it would be rejected. So the idea is if your actual payback period is less than the predetermined payback period, then the project would be accepted. Otherwise, the same should be rejected. Now, we are coming to the calculation. A project costs rupees 20 lakhs and yields annually a profit of rupees 3 lakhs after depreciation at the rate 12.5, but before tax at 50%. Calculate the payback period. The profit after depreciation 3 lakhs, tax 50%, that is 1,50,000. Add back depreciation, that is on 20 lakhs at the rate 12.5%, that is 2,50,000. So cash inflow is 4 lakhs. So payback period will be investment, that is 20 lakhs divided by 4 lakhs, that is 5 years. Now, 1 minute. Now, what I am telling, this particular payback period is calculated taking into consideration investment by cash flow. So cash inflow is 4 lakhs and you are going to recover the cost of the investment. So far, 5 years are concerned. It will take 5 years to recover the initial investment, and that is the payback period. Now, so here, in this case, we have assumed that cash inflow is even. Okay, so each year we are going to have the same cash inflow. But if we consider certain projects require an initial cash outflow of rupees 25,000. Okay, and the cash inflows that the particular company is going to get for 6 years, say this is uneven, that is 5,000, 8,000, 10,000, 12,000 and 7,000. Then how we are in a position to calculate the payback period, that we are going to discuss here. So we have made 3 columns. First column we have made here. Second column, cash inflows, rupees. Third column, cumulative cash inflows, rupees. So we have jotted down 5,000, 8,000, 10,000, 12,000. 7,000 and 3,000. And now we are going to take cumulative cash inflows, which is nothing but in year one, there is no question of any cumulative, that is 5,000. In year two, 5,000 plus 8,000, that is 13,000. Third year, 13,000 plus 10,000, 23,000. 23,000 plus 12,000, 35,000. Then 35,000 plus 7,000 comes to 42,000. Then 42,000 plus 3,000, that is the 45,000. Now, our investment is, initial investment is 25,000. Now, if you look into the cumulative cash inflows, that in 3 years, in the third year, we are going to recover rupees 20,000. And rupees 2,000 is the balance, which is to be recovered also. In the fourth year, the cash inflow is rupees 12,000. It means the payback period is 3 to 4 years. And that is to be calculated. That is payback period, complete 3 years plus 2,000 is to be recovered in the fourth year out of 12,000 multiplied by 12 months. So payback period we get 3 years and 2 months. I think you have understood. Now we are going to have the concept called post-payback profitability method. Now, as we have seen, so for the payback period is concerned, this payback period is not going to consider the profitability after payback period. And that's why we are going to have another method, that is post-payback profitability method. So one of the major limitations of payback period method is that it does not consider the cash inflows earned after payback period. And if the real profitability of the project cannot be assessed. To improve over this method, it can be made by considering the receivable after the payback period. These returns are called post-payback profits. Now, let us look into this. It is given from the following particulars. Compute, number one, payback period. Number two, post-payback profitability and post-payback profitability index. So we are having two questions and we are having two scenarios, A and B. In A, we are having cash outflow rupees 1 lakh. Cash inflow after tax before depreciation 25,000. Estimated life 6 years. Another situation, cash outflow 1 lakh, annual cash inflow after tax but before depreciation. Okay, first 5 years 20,000, next 5 years 8,000. Estimated life 10 years. and salvage value rupees 16,000. So we are going to take the first one, that is payback period. It is initial investment divided by 25,000, that is 4 years. So you see, life is given 6 years, and you are in a position to arrive at the payback period in 4 years. So post payback profitability is equal to cash inflow per year multiplied by estimated life minus payback period, that is 25,000 into 6 minus 4. It comes to rupees 50,000. Now, post profitability index is 50,000 divided by 1 lakh into 100, that is 50%. Okay. Now, second part we are coming, cash inflows are equal. Payback period is calculated. That is year 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And we are going to have each year 20,000 each year. And from the sixth year, we are having 8,000. So cumulative cash flow, we get 20,000, 40,000, 60,000, 80,000, 1 lakh, 1 lakh 8,000, 1 lakh 16,000, 1 lakh 24,000, plus 8,000, that is 1 lakh 32,000, and 1 lakh 32 plus 8, that is 1 lakh 40,000. Now, if we you see, post payback profitability, cash inflow, as because we see, so for the second part was concerned, cash outflow is 1 lakh. Okay. So we are going to have 1 lakh covered in the 5th year. So that is the payback period. Okay. Payback period is 5th year, where we are in a position to recover the entire 1 lakh. I haven't written here. Now, life is 10 years. And if we are going to recover the initial investment in the 5th year, then we are having 5 years more, and we are going to have cash inflow per year 8,000 multiplied by estimated life minus payback period. That is 10 minus 5,000 into 10 minus 5. So we get 8,000 into 5. It comes to 40,000. So that is the post payback profitability. Hope you have understood. Now, post payback profitability index, 40,000 divided by initial investment was 1 lakh multiplied by 100. It comes to 40%. Okay. So we have already covered payback period, post payback profitability, and post payback profitability index. Now we are coming to accounting rate of return or average rate of return. Now, what is the meaning of accounting rate of return or average rate of return? Average rate of return means the average rate of return or profit taken for considering the project evaluation. This method is one of the traditional methods for evaluating the project proposals. Because accounting profit is used, that's why it is called accounting rate of return. Now, there are certain merits and demerits. So, for accounting rate of return or average rate of return is concerned, amongst the merits, we are having number one, it is easy to calculate and simple to understand. It is based on the accounting information rather than cash inflow. Number three, it is not based on the time value of money. Number four, it considers the total benefit associated with the project. Now, there are certain demerits. It ignores the time value of money. Number two, it ignores the reinvestment potential of a project. Next, different methods are used for accounting profit. So it leads to some difficulties in the calculation of the project, the accounting profit. Now, what is the accept or reject criteria? If the actual accounting rate of return is more than the predetermined required rate of return, the project would be accepted. If not, it would be rejected. Now, let us look into it. A company has two alternative proposals. The details are as follows. Proposal 1, Proposal 2. Proposal 1, automatic machine. Proposal 2, ordinary machine. Cost of the machine. So for automatic machine is concerned, rupees 2,20,000 and ordinary machine rupees 60,000. Estimated life 5.5 years and proposal 2, 8 years. Estimated sales per annum, both the cases 1,50,000. Cost, material 50,000 for both the proposals. Labor 12,000 because it is automatic, hence labor intensity is less. But when ordinary machine to be used, more labor, that is 60,000 will be needed. Variable overheads for automatic machine is more, that is 24,000 for proposal 1 and for proposal 2 it is 20,000. Now, the question is compute the profitability of the proposals under the return on investment method. Now, we are going to have the calculation. Cost of the machine we have taken. Life of the machine 5.5 years and 8 years. Estimated sales, let it be A. It is same for both the machines. Less cost of material 50,000, 50,000. Then labor 12,000 and 60,000. Variable overheads 24,000 and 20,000. Depreciation is equal to cost divided by life. That is 2,20,000 divided by 5.5. That is 40,000. Ordinary machine 60,000 divided by 8. That is 7,500. So depreciation we take 40,000 and 7,000. Then total cost we are having 1,26,000 and 1,37,000. So profit we get 24,000 and 12,500. Remember, we are considering accounting profit. Now, return on investment, that is average profit divided by original investment multiplied by 100. So, in your automatic machine, it is automatic machine, it is 24,000 into 2,20,000 into 100. Now, just let me check the calculation once more again. It is 24,000 divided by 2,20,000 into 100. It comes to 10.9%. And 12,500 divided by 60,000 into 100. It comes to 20.8%. So, as far the return is concerned, ordinary machine having higher return on investment will be preferred so far the automatic machines are concerned. Now we are coming to the net present value. Please try to understand what is the meaning of net present value. Now, net present value method is one of the modern methods for evaluating the project proposals. In this method, cash inflows are considered with the time value of the money. Net present value describes as the summation of the present value of cash inflow and present value of cash outflow. Net present value is the difference between total present value of future cash inflows and the total present value of future cash outflows. So NPV is the difference between present value of all cash inflows minus present value of all cash outflows. Now, net present value having certain merits. It recognizes the time value of money. It considers the total benefits arising out of the proposal. It is the best method for the selection of mutually exclusive projects. It helps to achieve the maximization of shareholders' wealth. But obviously, certain demerits. It is difficult to understand and calculate. It needs the discount factors for calculation of present values. It is not suitable for the projects having different effective lives. Now, what is the accept or reject criteria? If the present value of cash inflows is more than the present value of cash outflows, it will be accepted. So, in other words, if NPV is positive for a particular project, the same is accepted. If not, it would be rejected. Now we are coming to solve a problem. Please look into the problem first. It is given from the following information. Calculate the net present value of the two projects and suggest which of the two projects should be accepted a discount rate of the two. Now, project X, project Y, we are having initial investment 20,000, 30,000. Estimated life 5 years for both these projects. Scrap value project X rupees 1,000 at the end of the life, and project Y 2,000. The profits before depreciation and after taxation, that is the cash flows. Cash inflows are nothing but profit after tax, add back depreciation. Remember, profit after tax, add back depreciation, or we may say the profits before depreciation and after taxation, cash flows. Project X, we are having different cash flows over the 5 years, and project Y also having different cash flows over the 5 years. Now, the following are the present value factors at the rate 10% per annum. So, as it is seen over the years, the present value factor is decreasing. Okay, money value is reduced. So we are having year 1, year 2, 3, 4, 5, and 6. Now, 1 minute. One thing you should remember, then I'll go. In the context of capital budgeting, the most important is selection of the projects. Now, projects may be mutually exclusive. Mutually exclusive means, say there are two projects, A and B. If you are going to select A, then you cannot select B anymore. And if you are going to select B, then you are not in a position to select project A. So these are called mutually exclusive projects. Another concept is dependent projects. Say there will be a power station, and if the power station is actually being made, then there will be other projects, schools, colleges, markets, etc., that will be undertaken, and that is totally dependent on the power projects. And another one is called independent project. Independent project means if you are going to generate power, then you should have power plant. So it is not dependent on others. So it is called independent project. That I want to discuss. That's why I have discussed with you. Now we are proceeding. You see, we are having cash inflows for both project X and project Y. And present value factor or the discounting factor at the rate 10%, then present value of net cash inflow, project X, project Y. Now, cash flows from the different projects we have jotted down. There is cash flow for project X, we have jotted down. Cash flows for project Y, we have jotted down. Then the factors, discounting factor, that is present value of rupee 1 at that at 10%. The discounting factors are also provided. If it is not provided, you can generate it through calculator. Now, we are writing present value of net cash inflow. That is for project X, 5,000 into 0.909. That is 4545. Then for project Y, 20,000 into 0.909, it comes to 18,180. Then again, 10,000 multiplied by 0.826. For X, it is 8260. And for Y, it is also 8260. Year 3, we are having project X, 10,000. Project Y, 5,000. So 0.751 multiplied by 10,000, it comes to 7510. And for project Y, it is 5,000 into 0.751, it comes to 3755. Fourth year, it is 3,000 both. Multiplied by discounting factor 0.683, we get 2049 for X and 2049 for Y. In the fifth year, we are having 2,000 each multiplied by 0.621. So it comes to 1242 and 1242, both cases. At the end of the fifth year, there will be generation of scrap. So far X project is concerned, scrap value will be generated, that is 1,000, and Y 2,000 is given in the question. So it is multiplied by respectively 1,000 into 0.621, that is 61, and 2,000 into 0.621, it comes to 1245. So total present value comes to 24,227 and 34,728. Now initial investments 20,000 and 30,000. So net present value we get 4,227 and 4,729. So Y has yielded more net present value as compared to X. Hence, project Y should be selected. We are coming to next question. Please given, just read the question, please. Please read it. It is given the following are the cash inflows and outflows of a certain project. We are having year, then outflows, then inflows. The salvage value at the end of 5 years is 50,000. Now, taking the cut-off rate is 10%. Calculate net present value. Now, the question comes, what is the meaning of cut-off rate? Cut-off rate, same as discounting rate, and it is also can be considered as weighted average cost of capital. Okay, and it may be also termed as minimum desired rate of return. Okay, so parallel to years, we are having the present value factor that is given. Usually it will be given in the question. If it is not given, then you can easily calculate through calculator. I'm just telling you, say if it is 10%, then 1 divided by 1.1. Okay, it comes to 0.909. Then you multiply, you just press multiplication sign in the calculator twice. Then make is equal to, you will get second year discounting factor, that is 0.826. Then you do press is equal to button in the calculator. Then it will be 0.751. Then again you press equal sign, is equal to sign as given in the calculator. Then it will be 0.683 and so on and so forth. So you can easily calculate. Now, we are jotting down the figures in the form of years 1, 2, 3, 4, 5. Again, there will be salvage. Okay. Now, the salvage value at the end of 5 years is 50,000. So we have taken cash inflows 35,000, 45,000, then 65,000, 85,000, 50 or 50,000, and again 5th year at the end of the life, there will be a scrap value to the extent of 50,000 that we have taken, and we have applied present value factor or discounting factor at the rate 10%, as it is given 0.909, 0.826, 0.751, 0.683, 0.621, and again in 5th year there is a salvage that is 0.621. Cash inflows multiplied by present value factor, we get present value of cash inflows. So first year, 35,000 into 0.909, it comes to 31,815. Then 45,000 into 0.826, it comes to 37,170. 65,000 into 0.751, it comes to 48,815. Then 85,000 into 0.683, that is 58055. 5th year, 50,000 into 0.61, that is 31,050. And 5th year, again, there is a salvage inflow, scrap value, that is 50,000 into 0.61, It comes to 31,050. So total present value of cash inflows we got 237,955. Now, total present value of outflows, cash flow at the beginning of the year, 1,75,000 multiplied by 1, because it is done in the 0th year, and cash outflow at the end of the first year, that is 50,000. Okay, that is 0.909. It comes to 45,450. Please consider this as 50,000. Okay, so it is not 5,50,000, it is only 50,000. Okay, so at the end of the first year, it will be 50,000 into 0.909. It comes to 45,450. So 1,75,000 plus 45,450. So total value of outflows, it comes to 2,20,450. Total present value of all cash inflows we have got 237,955 less total outflows 2,20,450. So net present value we got 2,37,955 minus 2,20,450. It comes to 17,505. Now, one thing you have to remember, if the cash inflows are not given, in that cases, the calculation of cash inflows are net profit after tax plus depreciation. In this type of situation, first, find out the net profit after depreciation and deducting the tax, and then add the depreciation. It gives the cash inflow. Okay, so that is all about your NPV. It is 5,50,000, please. It is not 5,50,000. It is only 50,000. There is a typing mistake actually. So 1,75,000, and then at the end of the year one, it is only 50,000. Second year investment cannot be more than the 0th year investment. It is impossible. So it is only 50,000. Please consider that. And on the basis of this 50,000, we have calculated, and it comes to 45,450. Hope you have understood. Now we are coming to the most important and most tricky calculation, that is called internal rate of return. Now, what is that? Internal rate of return is time adjustment technique and covers the disadvantages of the traditional techniques. In other words, it is a rate at which discount cash flow to zero. It is expected by the following ratio: cash inflow divided by investment initial. Now, steps to be followed. Step one, find out factor. I'll discuss. Let me tell you this. Then I'm going to discuss. Step one, find out factor. Factor is calculated as follows. Factor is equal to F is equal to cash outlay or initial investment divided by cash inflow. Step two, find out positive net present value. Step three, find out negative net present value. Step 4, find out formula of net present value. Then we have to use the formula IRR is equal to base factor plus positive net present value divided by difference in positive and negative net present value multiplied by DP. DP means difference in percentage. I'll explain everything, please. Base factor is positive discount rate and DP means difference in percentage. I'll explain. Now, what are the merits? It considers the time value of money. It takes into account the total cash inflow and outflow. It does not use the concept of the required rate of return. It gives the approximate or nearest rate of return. Demerits, it involves complicated computational method. It produces multiple rates which may be confusing for taking decisions. It is assumed that all intermediate cash flows are reinvested at the internal rate of return. Now, how to accept or reject a project? That is accept or reject criteria if the present value of the sum total of the compounded reinvested cash inflows is greater than the present value of the outflows, the proposed project is accepted. If not, it would be rejected. Now, I'm just taking into account the concept of internal rate of return. Let me explain. Now, you see, in case of net present value, we have already considered a known discount. Please listen to me first. In case of net present value, we have considered a known discounting factor. That is the cutout rate or cutoff rate. That is the discounting factor, okay, or the weighted average cost of capital, or it is the minimum desired rate of return. That we have used in the case of NPV. But internal rate of return, as the name suggests, finance managers are considering the internal rate of return on a trial and error method. Okay? Internal rate of return is that return at which present value of all cash inflows exactly is equal to present value of all cash outflows. So NPV is equal to 0. Now, internal rate of return lies between two NPVs. One is positive NPV and another one is negative NPV. Once we calculate the NPV, the positive one, and NPV, the negative one, then we are going to use a formula of internal rate of return to calculate the IRR. Now, please try to understand. Now, I am just considering this problem to make you understand. Okay. You see here, what we are doing, That is calculation of IRR. That is internal rate of return. A company has to select one of the following two projects, because both the projects cannot be selected, because these are called mutually exclusive projects. If you are going to select project A, then you are unable to select project B. Okay. Now, I'm just showing this calculation, but again, I will just tell you an easier technique to calculate the IRR. Just first look into this. We are calculating factor F. Okay. That is cash outlay divided by cash inflow. Project A cash inflow, that is 28,000 divided by 4, it comes to 7,000. And 22,000 divided by 7,000 is a factor, that is 3.14. Now please look into this. But I'll be telling you the most easiest technique of calculating the IRR. Now just you look into this. Factor we are considering cash outlay divided by cash inflow. Now project A, we are having cash inflow. Total cash inflow is 12,000 plus 4,000. That is 16,000 plus 2,000, 18,000. 18,000 plus 10,000, it comes to 28,000. And how many years given? 4. So we are having cash inflow per year is 7,000 on an average. And then factor we are going to calculate 7,000. Okay. That is 22,000 is the outflow, cash outlay, and cash inflow is 7,000. So 22,000 divided by 7,000, we get 3.14. Okay. Now, the factor thus calculated, that will be available from a table. Okay. And this would give the estimated rate of return to be applied for the discounting the cash for the internal rate of return. Now, 3.14, for A it comes to 10%, and for B it comes to 15%. Now, what I am telling you, in case of project A, cash inflows we are taking discounting factor at the rate 10%. We have calculated the present value we get, that is cash inflows multiplied by discounting factor, and adding we get 22,544 less initial investment 22,000. So net present value is 544. Okay. Now we have to choose another rate where the net present value will be negative. Because I have already told you that internal rate of return lies between one positive NPV and one negative NPV. Okay, so discounting it at a factor of 10%, we arrive at the net present value of 544. Now, if we take a higher discounting rate, okay, we have, if we take higher discounting rate of 12%, okay, then we get the net present value as negative, that is 312. Then we are going to apply the formula IR is equal to base factor, that is 10%, like positive net present value divided by difference in positive and negative net present value multiplied by difference between the factors. So base factor is 10%, DP is 2%. Then positive net present value is 544. Then difference in positive and negative net present value, that is 544 minus, and within bracket we have to write minus 312. And difference between 12% and 10%, it comes to 2%. So practically we get for project A, internal rate of return is 11.27%. Now, I'm telling you a quick technique. Just look into this problem. Just look into this problem and restrict yourself to the problem itself. Using the internal rate of return method suggests which is preferable. Now, definitely you are going to calculate the internal rate of return for project A as well as project B. Now, internal rate of return is that rate of return which lies between one positive NPV and another one is negative NPV. So, what you are required to do, you are required to start with, you have to write by trial and error, let the discounting rate be 10%. So, minimum return is required 10%. So, we have to start with a return of 10%. And we should go for calculating the net present value, considering 10% as the discounting factor as trial and error. Now, once you calculate this, you will get NPV is equal to 544. Now you have to arrive at a negative NPV for which you have to take a higher rate of discount. You can take 15%. You can take 20% even. But ultimately, the adjustment will be done through internal rate of return formula. Now, let me discuss this to you once more. Please listen to me carefully. Now, what I am saying, please try to understand what I am saying Suppose in a particular problem, you are required to calculate the internal rate of return. As we know, internal rate of return is the return that is to be calculated through trial and error method. In case of NPV, the desired rate of return is the cutout rate or cutoff rate or the weighted average cost of capital that is available. And with that, we can calculate the NPVs. But as the name suggests, IRR, internal rate of return, for that we are going to select rates through trial and error. So you see, minimum return may be 10%. You just consider. You start with 10%. And if you see the NPV that you have arrived at after considering 10% return, the NPV is positive, then you should not waste any time, because time management is to be made in the examination hall. So directly go to a very high rate of return, say 15%. Then you will see obviously the NPV will be negative. Okay, so we are getting one positive NPV and one negative NPV. Then you are required to apply the formula, that is lower rate of interest, lower rate of discounting factor, say 10% plus net present value positive divided by net present value 1 positive minus net present value negative, multiplied by difference in discounting factor, and that is going to give us the IRR. Okay, so sorry. That is going to give us the IRR. Now just a minute, please. So we are now looking into this. Say 10% we have decided, okay, and we got NPV 544, and 12% we have decided, then we have got NPV that is negative. So IRR will be base factor, means initial factor that we have taken 10%, plus positive NPV, that is 544, divided by difference in positive, that is 544 minus 312, multiplied by 12% minus 10%, that is 2%, we get 11.27%. Okay. Similarly, for project B, we may calculate in the same fashion. First select 10%, then you go for higher rate of return. Okay, discounting factor you are going to choose higher, so that you can get a negative NPV. And after calculating the IRR, if it is seen that project A having higher rate of return, then A should be selected as compared to B. So that is the internal rate of return. Now, for your convenience, just give me 2 minutes time. Then again, I'll be discussing with you, because students, they generally feel uncomfortable while calculating the internal rate of return in the examination hall. So please allow me 2 minutes. Then again, I'll be discussing with you the IRR, how you should go ahead, and then we'll come to profitability index. So please allow me 2 minutes. Now please listen to me carefully. While calculating IRR, what you are required to do first, because you may not be provided with any discounting factor. So you have to write, by trial and error, let us consider the discounting rate be 10%. And with the discounting rate, let us proceed to calculate the IRR. Let us proceed to calculate the net present value for the computation of IRR as under. So you have to give the heading computation of net present value considering discounting factor at the rate 10%. If you see at 10%, the NPV is positive, then instantly we should consider a very higher rate of return where definitely the NPV will be negative. So where there you have to write, by trial and error, let us consider the discounting factor be, say, 20%. So you will first see at 10% how much NPV is positive. So you may take higher rate, that is 20%, and you calculate the NPVs. You will see the NPV will be negative. Then you are going to apply the formula, that is lower rate of interest plus positive net present value at lower rate divided by difference between NPVs, that is positive NPVs minus the negative NPVs, that is minus will be plus, multiplied by difference in interest rate, that is 20% minus 10%, that is 10%, 20 minus 10, that is 10. Then we'll be in a position to arrive at internal rate of return. Hope you have understood. Now we are coming to profitability index, that is PI method. Now profitability index method measures the present value of benefits for every rupee investment. In other words, it involves the ratio that is created by comparing the ratio of the present value of future cash inflows from a project to the initial investment in the project. This method is also known as benefit cost ratio, And Van Horn, he has said the profitability index of a project is the ratio of the present value of future net cash inflows to the present value of cash outflows. Actually, the profitability index is just a fraction. The profitability index is equal to the present value of future cash flows divided by the cost of the investment. Present value of future cash flows simply means the money that you expect to make from the investment. Initial investment refers to the money that the firm have to put down to make that money. So formula should be profitability index is equal to present value of the expected cash inflows divided by present value of cash outflows on initial investment. Now, accept reject criteria. If the profitability index PI is greater than or equal to 1, the project should be accepted, otherwise rejected. Specifically, if the PI is greater than 1, the project generates value and the company may want to proceed with the project. If the profitability index is less than 1, the project destroys value and the company should not proceed with the project. If the PI is equal to 1, the project breaks even and the company is indifferent between proceeding or not proceeding with the project. So, the higher the profitability index, the more attractive the investment. The accept reject criterion under the profitability index method can be understood by the following equations. If PI is greater than 1, then you have to accept. If PI is less than 1, then you have to reject. If PI is equal to 0, then may accept or reject. So you are indifferent. Okay? So that is all about your capital budgeting. Now we are coming to solve some problems. Company X is forced to choose between two machines, A and B. The two machines are designed differently, but have identical capacity and do exactly the same job. Machine A costs rupees 1,50,000 and will last for 3 years. It costs rupees 40,000 per year to run. Machine B is an economy model costing only rupees 1 lakh, but will last only for 2 years and cost rupees 60,000 per year to run. These are real cash flows. The costs are forecasted in rupees of constant purchasing power. Ignore tax. Opportunity cost of capital is 10%. So here opportunity cost of capital is 10% means if you are not going to invest money in the projects, then you can go for and put the money into the bank or may invest in others so that you can get a return of 10%. That is called opportunity cost of capital. Now the question is, which machine company X should buy? So you have to make a table that is statement showing the evaluation of two machines. So we are having two machines, that is machine A and B. Purchase cost 1,50,000 and 1 lakh. Life of machine in years 3 and 2. running cost of machine per year, 40,000 and 60,000. Now, annuity factor means cumulative present value factors for 1, 2, 3 years. That is year 1, year 2, and 3 years at the rate 10%. That means if we take discounting factors at the rate 10% for first year, second year, and 3 years, and if we add all these, then the factor that we get, that is called cumulative present value factor, which is also termed as annuity factor, and we get 2.486. Similarly, cumulative value factor for 1-2 years at the rate 10%, that is applicable for B machine, that is 1.735. Now, present value of running cost of machines that we get, item number 2 multiplied by the cumulative present value factor for 1 to 3 years at the rate 10%, we get 99,440. And in case of machine B, that is 3 into 4, we get 1,04,100. Then cash outflow of machines, that is number 6 is equal to number 1 plus number 5. It comes to 249,440. And for machine B, it comes to 204,100. Now, equivalent present value of annual cash outflow, how we get, that is 6 cash outflow of machines divided by the annuity factor 2.486, we get equivalent present value of annual cash flow. It is 1,00338. And in case of machine B, it is 204,100 divided by cumulative present value factor for 1-2 years, that is 1.735. Then it comes to 1,17,637. So we have to translate the figures in terms of annual cash outflow, because here inflows are not given. Hence, we cannot make a decision by calculating NPV. That we cannot do. That is net present value. That is present value of all inflows minus present value of all cash outflows. Here we cannot do. So our decision should be based on annual cash outflow, that is equivalent present value of annual cash outflow. And we observe that equivalent present value of annual cash outflow for machine A, it is 1,00338, which is lower than machine B, that is 117,637. Hence, company A should buy machine A since its equivalent cash outflow is less than machine B. Hope you have understood. Remember, this type of problem may come in your exam. Now we are coming to next question. Given below are the data on a capital project M. Annual cash inflows given rupees 60,000. Useful life is given 4 years. Internal rate of return given 15%. Profitability index 1.064. Salvage value is 0. Now, we are required to calculate for this project aim. Number one, cost of project. Number two, payback period. Number three, cost of capital. And number four, net present value.